Welcome back, everyone. This is part two of the Pulp Nonfiction session with Marc Schouten. The first session we talked finances, very Canadian-centric, but with some perhaps rules or some insights that perhaps could be used outside of the Great White North. Now we're moving on to the super exciting, dynamic topic of insurance. I'll take my hat off to you, Marc, as I do in August for the ride. Carry on. And I'm always disappointed when I take off my hat. I'm like, oh my God. Oh, yeah. Anyway, you used to have a full head of hair before this COVID thing came in, and it's just been, you pulled your hair out over some of this stuff, right?
Yeah, I think of it as being aerodynamic.
There we go. Yes. Smooth. I'm with you. I'm with you. I'm not that far behind you, so I'm catching up. It's kind of like the bike ride.
Yeah.
All right. So you're going to chat a bit about insurance and
absolutely.
COVID's, taken a world and rattled it. And how's it rattled insurance?
Yeah, well, in the broader context for insurance, especially as it relates to dentistry and any professional market, to be honest, or any high income people. One of the basic things about insurance from a Canadian perspective is that it's one of the few sort of places where we actually have an asset class where we have some tax advantages. So it's something that as part of a financial planning practice in Canada, I wouldn't call it a necessary evil, but it's certainly something that we need to include in our planning to be able to come up with some sort of tax mitigation, essentially, at the end of the day. And then on top of that, there is a significant need for high income producing people to have different insurance products. And that runs the gamut from personal protection of your income to protecting your families and all the usual stuff. We'll take a bit of a dive into that. My goal for this really was to take a look at maybe some areas where we don't normally think about. This is a little bit like when we were talking about in the financial part, saying, well, what are the things you can do? What use can you make of this time? One of the simple ones would be for your practice, writing up policies and procedures or updating it and making it current and what have you. Similar idea, basically saying, well, you finally have the time to step back and kind of look at stuff, collect information, and do these things. And I really wanted to think of it sort of like cleaning out the insurance shed. We tend to, a little bit like our shed collects various things over time. Very often insurance is that same way. Something's purchased for a particular reason at the time, or it sounded like a good idea. But sometimes, if I looked at my shed right now, I'd probably have, I probably have 3 different containers of gear oil, or I have, all sorts of different things. So I think it's kind of a good time to take a look at your insurance portfolio in general. If you're working with one person who has provided everything, it's usually an easier sort of process, or that's done on an automatic, like on a regular basis as we would do this. But I find the vast majority of people, it's just sort of been hit and miss. I bought this when I was in dental school. I got this then. Getting different things over time, and then basically just putting them on the shelf or putting them in the filing cabinet and saying, oh, okay, yeah, I don't need to think about that again. So I thought it makes sense to take some time to sort of say, what are the things can we unpack about insurance, and maybe expand on a couple of topics of areas where we often aren't taking the time to look at it, or just with the schedules that our clients have, it's really hard to prioritize enough of it to say, okay, let's break this out. So that's what I was hoping we could do now. Does that sound fair?
Oh, yes. Yeah, no, absolutely. Yeah, I was waiting for the next slide to come up. Yes. No. Let's have a look at insurance there. And that's not monopoly money. That's Canadian money, just for those people who are unaware. Yep. But yes. So, have a look at your insurance. Yeah, I on a personal note, everyone most dentists in Canada are kicking up a fuss about pandemic insurance and the lack of coverage thereof. My dental shed, I realized I didn't have office overhead insurance. So pandemic be damned, it doesn't matter, I'm not covered. And And so, yeah, I fell guilty of that. I thought I had something in my shed, and that was not in my shed. So that was rather sheddy of me.
Uh,
Yeah, you knew it was coming. You knew it was coming. All right.
oh, that is no guano.
All right. You've been
Uh,
interviewed by Michael Scott here. Okay. That's what she said. All right. Sorry, I digress. Carry on.
That's fantastic. Yeah. So okay, and actually, it's a good point to make. So the type of insurance that we do as financial planners that comes into a practice, that would fall under personal insurance. So your BOE coverage, your business overhead, those policies in general, those are actually like a type of personal disability insurance. So if there was something that happened, let's say you, I don't know, something crazy, if you fell while skiing and hurt your knee. If something like that happened, business overhead insurance would cover your cost of your overhead, and one of the big things often is depreciation as well. But the interesting thing is it actually is stuff that it directly impacts you. If you were personally impacted by COVID, and you were made sick by it and you couldn't work because of that after the elimination period, it would cover you for that. But if your clinic was closed because of COVID, it actually falls under property and casualty insurance, which is a different type of, different area of coverage. It's external factors causing your business to be closed. It would be looking the same as looking at a, if you had a flood or a fire, if those things happened. And then, there's been, obviously I've been getting a lot of feedback from clients with frustration around pandemic coverage not paying out in BC in particular, for the thinnest of reasons. So yeah, it's a huge frustration around that. So on my side, on the insurance side, basically the two things really to think about, a little bit like what we were talking about before, basically make sure cash flow is good, make sure you're getting value, keep things as reasonable as possible, but then also in a broader perspective, making sure that you plan, that you really understand what your insurance is for, and that you're maximizing the value of it. If you have it, you might as well make full use of it, right? These products, I find there can be a fair bit of complication around structures and things. This will be largely Canada specific. I know other jurisdictions use permanent insurance, but for the basic insurance, a lot of the stuff that I'll be talking about, the nature of insurance, is pretty specific to Canada in particular. But some of the concepts around how the value of permanent insurance increases over time or as an asset class will probably be pretty relevant, certainly to the US and to any Commonwealth countries. So if we dive into life insurance, I broadly break life insurance into three areas. You have personal protection, corporate need, whether that be loans or for a corporate agreement, a USA buy-sell agreement, for example, or as an investment class. So basically, this is the simplest part. This is no different than when we talked about, taking a deep breath and opening your investment statements, going back and taking out the insurance coverages that you have, and saying, okay, is what I have sufficient? Is it excessive? And does it last the term of need? This is something that very often we find insurance has sort of been bought here and there. It tends to have pretty big gaps in cost over time. If you bought some term insurance, it's one of these things where you basically need to look at what your risk factors are. The biggest risk factor usually is kids. If you have a 5-year-old, you probably have a 15 to 20-year need for the coverage to protect them. If you have a 15-year-old, you have significantly less time. The other small areas of this, and I cannot tell you how much this comes up, is especially where people have blended families or previous relationships, is to check beneficiaries. this will normally, either you need to check the original policy or contact the person who was managing your policy. I have had, my record is 2 relationships old for a beneficiary. And I have never found a spouse who saw the humor in the situation of seeing the ex-wife, or in this one person's case, his previous common law wife before his ex-wife. The new partner did not see the humor in that name popping up. And these beneficiary designations are not things that are easy to undo. If it's written it's written into the contract, the death claim goes in, it pays out directly. There are very few exceptions on how you can open that up, and it involves a very detailed court case. And it's not, in Canada, it's not probatable. It doesn't go through your estate. It bypasses the estate, so it pays out very quickly. But it will pay out directly to that beneficiary. And there are lots of situations where it's paid out to the wrong person or not the intended person. So it's something it's one of those basic housekeeping things, and it's so easy for one of those policies in the shed to have exactly that. There are also situations where you have, return of benefits on death, or these small additional riders and things. Those each have beneficiary designations as well. So it's one of those times where you say, well, if you can take the time to go through these policies or have it reviewed and have somebody report to you who the beneficiaries are for each of your policies, it's a very good idea if you've ever had a separate relationship, or even making sure that it's not paid into your estate. In Canada, going through the probate process normally is about 2 years. If the policy pays into the estate and everything needs to be settled, usually the money from insurance is actually going, the plan for it is to go to pay, final expenses and to transfer directly. And then not have probate fees, which vary across Canada. They tend not to be overly onerous, but it's more for the speed of that return. And the last one, and this is one that we see in so many situations, is how you own it. If we're talking about life insurance in Canada, for term insurance in particular, it flows through a corporation tax-free. So my argument always is, if you have a corporation, you're going to keep it for the next few years. I'd much rather pay with corporate dollars. In Canada, a small business net revenue under $500,000 pays about 11% tax. Most of my clients are in the 45 to 53% tax bracket. I'd rather use an 89-cent dollar than a 55-cent dollar to pay for exactly the same thing. Life insurance pays out tax-free from a corporation. It's a little bit of it's an anomaly, but life insurance and term insurance, we have a terminal. If you have a business owner and they pass away, you value their assets immediately previous to death. Well, an insurance policy immediately prior to death doesn't have any value. Immediately after death has whatever the benefit amount is. That flows through what's called our capital dividend account, and it flows out to your family tax-free. So it involves some paperwork to make that change, but it is worth the time, and especially when we have some free time now. This is the kind of thing, is one of the first things we always do when we work with a new client, and we go through this and we say, okay, that can be held by your corporation. Let's just make that change. It can be done because an advisor didn't know you were incorporated, or you weren't incorporated yet. Sometimes it's just done for convenience. There's a lot less paperwork doing a personal insurance policy than doing a corporate owned. Not a lot more, but it is more work, and you have to look up a few things.
Mm-hmm. Yeah, it reminds me of an interesting story. 2 specialists who shall remain unnamed had gone into business together. There was an older specialist, and he had his practice, and then the new grad guy joined him. They both took out life insurance policies on each other, and then the partnership didn't, go to fruition. They kind of went their separate ways. So the new guy ended up setting up his own practice. And I knew the old guy. Well, I knew both of them. And the old guy said, the new guy phoned him and said, you know what? I still have this insurance policy on your life that we took out 5 years ago. Do you want to buy it off me so that your family member, whatever, the beneficiary instead of me, right? Because
Yeah.
you're getting to that age now where you can't buy life insurance, and I got this, and it's no longer relevant because we don't not in partnership with each other. Anyway, the guy passed on it. He's like, yeah, no, I'm not, because obviously the younger guy was like, well, it's a benefit, so what do you want to pay me to have the insurance switch to you? And the older guy's like, yeah, no, thank you.
That's yeah, and it is, and I'm guessing in that case it's the other partner was the owner of the policy.
Yeah, yeah. So they both took it out on each other. So I guess
Yeah.
anyway, the beneficiary was the young guy. So the old guy died. The young guy got a bunch of money, and vice versa. So that then what happens is you don't have to worry about the value of the practice or anything. The spouse just gets the life insurance proceeds.
Yeah.
Right.
Perfect. Yeah.
So it's like
That's
nice and clean.
Yeah, and then we'll talk about that in the next slide as well. But yeah, it is so important to structure these things properly, and that's a perfect intro to this slide. So
you see, I work my magic, behind the scenes to make you look good.
Well, and that's a perfect anecdote because it does bring up that issue. We see some situations where insurance has been bought. It's a requirement of a loan. New practice owner setting up their practice, $1 million of coverage, collaterally assign it to the bank, and so we always say, okay, well, let's make sure that it's still required. In a lot of situations, we're going to repackage it for some other purpose, but if you paid off the loan, it doesn't need to be collaterally assigned. Yeah, where you have a buy-sell agreement, you've explained it well, right? Is that the life insurance automatically pays out the share of the business of the other person. The issue that we see on our end very often is where you have a buy-sell agreement, put in $500,000 of life insurance, let's say, when they first set up the practice, it's gone up to $4 million in value now. Well, the problem is we have the $500,000 from the life insurance. Where's the other $1.5 million coming from if somebody passes away unexpectedly? And that's more often the case. I mean, as we see, obviously we work with dental practices and they go up in value really quickly. So we've seen more situations where it's been a liability from not having enough. But it is something where lining up your corporate documents and your insurance is really critical. I'll be honest, on the life side, it's usually pretty straightforward. We just have to say, okay, well, what's half the value of your practice? What would it be bought out for? Let's make sure we have that much insurance. The bigger difference has been more around disability insurance. And I didn't actually put a slide in for disability insurance, but on buy-sell agreements, that's actually been more of the, not a bone of contention, but one of the areas where we see a gap in how a buy-sell agreement is written. And we very often will have a disability insurance component where you have a lump sum of disability insurance that says, well, if this person's disabled after 2 years, we have an automatic trigger, or after some amount of time, we have an automatic trigger that pays out X amount of dollars, which pays out the buy-sell agreement, because it's paying out half the value of the corporation, or actually, let's say you don't have a buy-sell agreement, you both own the practice, and once somebody passes away, pretty hard is the person who's solo running the dental practice to send half the revenue or half the profits off to another person when there's not the value of that work being done. But it's exactly the same, or even sometimes more difficult, when that person has become disabled and they can't work anymore. They're home, they have usually extraordinary costs at that point. And no funding mechanism. The other partner is trying to keep everything going and has a person, they haven't been able to trigger the buy-sell agreement if it just has life insurance in it. So the area where the two need to be reviewed is putting the buy-sell agreement beside the disability insurance and just making sure that the timing of those two documents trigger at the same time. You just don't want to have a gap between those two. CDA issue. This is sort of a small one, but it's something I like to mention, and I'll put in a link to the case. It's actually an interesting court case. What I find interesting about it is that this is something where I'd said about life insurance, when it pays out tax free, right? And you probably have seen in your corporate information that you have a capital dividend account. That's basically if you sell some capital property, it's 50% non-taxable, as we talked about in the first interview. That 50% flows through your capital dividend account. Well, your life insurance flows entirely through your capital dividend account. There was this case in Ontario where they used key person insurance, and this is also a good time to, as one of your corporate policies, to look at your key person insurance. In this case, it was a nursery. They had a key manager who passed away. They had $500,000 of life insurance, and they had an agreement that said that you're going to pay that out to the estate for this key person, right? So one of the employee retention tools. What's interesting is that the nursery, as a company, decided, okay, well, we'll pay you out that $500,000, but we're going to keep the capital dividend account credit for ourselves. So that $500,000 was taxable as income to the estate, but the nursery actually got the ability to flow $500,000 out of their corporation to the shareholders tax free. It's one of these things that until that case came up, nobody really thought of specifying that in an agreement. So there are all these little areas, and it's an interesting case to read. So in the end, they said, well, it wasn't a benefit, saying that they had said, this is the way it goes. So that it's at the discretion of the company to decide how they want to manage that. So and then actually on the structure side, it's a good time to also consider key person insurance, or if you have key person insurance, if it's still appropriate and structured properly.
So at the nursery, when it finally came to fruition, there was some sour grapes. Sorry, I couldn't resist. No olive branches were handed out. No, there was a crown of thorns, but they also had $500,000 that they could tax-free flow out of their corporations personally. So yeah, but I would imagine the state was expecting that to flow tax-free.
Yeah,
that does seem a bit opportunistic of that nursery.
It is. I mean, and you think about, let's say that was BC. This was an Ontario case, but if that was BC, 270,000 of that would have been taxed at 53.5%. The other part, marginal tax rate below 220, on average, call it 40%. Basically, it brought it down pretty close to half of what the value would have been otherwise, right? And it forced it all into one tax year. Mm-hmm. Kind of a cruddy thing to do, but within their right, apparently. Yeah. So, so the last area that I want to talk about on life insurance, and this requires a little bit of a step back. This is my basic, this is the way that I always describe how insurance really works, because I find very often there's just sort of a gap. We've heard a lot of the terminology. We've heard the terminology. We sort of know them as general classes, but we don't really know how they're made up. So when we talk about investment, like insurance as an investment, it makes sense to take a bit of a step back and say, okay, what is the nature of insurance to start with, and why does it do the things why does it do the things that we want to do, and what do we use it for? This is always the graph that I use for describing insurance. The red line that you see there is basically if you went to an insurance company year after year and said, I want you to insure me for the next year, I want $1 million of insurance. Obviously, when you're at the bottom of the graph on the far left, you're 20 years old and perfectly healthy. Not going to cost you much. It's going to cost you $25, $30. You ask them that same question when you're 70, they're going to want a few thousand, probably $1,000 a month. So that would be the annual renewable cost of it. Term insurance is just flattening out one section of that curve to a flat rate for a particular time period. Term 10 insurance being the most common. Because of the slope of the curve, you end up with steps that get gradually larger and larger. Eventually, they're simply not going to offer it anymore. You're 92 years old. They don't want to sell you any term insurance. Permanent insurance is where we have insurance as an investment class. Permanent insurance basically just takes that entire red line and flattens it into one cost. The idea being you're going to pay this cost for the rest of your life. You're going to keep this in place. And at some point, you're going to pass away. If you pass away too soon, the insurance company made a bad bet. If you pass away at 117, then the insurance company made a great bet, right? The part of insurance where this becomes an asset class is when we can add, with permanent insurance, we have the right to put an investment account on top of the insurance. So that basic orange line, which is the annual cost, we're allowed to have investments I describe it as a bucket. That investment account is allowed to be built up with the intention that it's eventually going to take over the cost of that insurance. The reason that we're using this in Canada, obviously, you know how hard it is to grow money in a corporation or outside of a corporation, honestly, without being excessively taxed. As part of the tax proposals that we had that started a couple of years ago, we have a limit of being able to only earn $50,000 of investment return within a corporation before we start losing our small business deduction, right? So where I talked about that 11% tax, that tax jumps up for Canadians up to 27%, for British Columbians at least, up to 27% when we exceed the small business deduction. And basically they have a sliding scale that claws back your small business deduction. So this is one of these things where we like this as an investment class because we're able to put corporate dollars into it, but it doesn't get dragged back by tax, and it also doesn't reduce, the returns also don't reduce our small business deduction, right? So we're able to keep ourselves as a small business corporation, which makes a big difference. As an investment class, it is on the conservative end of investments. We're certainly not going to see, blow the lights out, small cap equity kind of returns. We're going to see very, very similar to bond rates plus a few percent. Canada Life has been doing this. I think they were the first since 1848. So we went through the Great Recession, we went through the World Wars, we went through 2000, 2008, all of these things. They've always paid a positive return. And that's one of the benefits, is that the return is paid out as a dividend. There's no such thing as a negative dividend, so it's always going to be a positive return. On the other side, if the markets have a 20% year, you're not seeing 20% in one of these investment classes.
Yeah.
Right? So this is for money that could otherwise be in a GIC. This is a good alternative to that.
Yes.
The interesting thing about this is that flat line, in actuality, the flat orange line, actually, the insurance policy, the returns of the insurance policy can actually either go into creating a larger investment account, but it is capped at a certain point. It also has a contractual right to be able to buy more insurance. So that ability to invest in itself and create a larger insurance policy is really where you see the long-term growth of these policies and the value of the asset. Because as you create a larger insurance policy, now you're creating a larger bucket essentially, which means that you're allowed to have more money flowing into it. So it reinvests in itself and expands itself.
The corporate asset, you can lend against it.
That's the big thing.
Yeah.
You can borrow against that. Now, this is something that I've been mentioning to people. We can use this if you have money built up. The way that we value that is called a cash surrender value. I like to define that basically for people. It is exactly what it sounds like.
So
It
instead of
means if
committing
you,
suicide or killing your spouse with the insurance, just borrow against it. It makes for a boring movie, but less investigations.
less investigations, a little more paperwork on my side, honestly,
Yeah.
but definitely a preferable outcome. Um, so it's a cash surrender value really is, it says, if I took this insurance policy and I walked it over to the insurance company and said, how much will you give me to take this liability off your books? If you have $1 million of, if you have $1 million insurance policy when you're 34 paid up, they'll say, not very much. If you're 84, they're going to have a much higher number. So that goes up in value over time.
Mm-hmm.
What the banks like about that, you take that to any conventional lender, and that lender will say, okay, well, I have a guaranteed value
Yeah.
that it's always going to be worth at least this much. So I can lend you against that as a corporate asset. Now we have structures where we can borrow that corporately and then pay out as a dividend, or we can also borrow against that personally. It's a structure that we use, that we plan for quite a lot, because it is one of the places where we can actually get some personal benefit by paying a guarantee fee. And there's a few mechanics to it, and we'll go a little bit deeper into it, but it is a structure that's very often used. Now, my reason for saying this is that this is really an important time where you do have the time to look at this and to sort of do some research and to understand the implications. I usually find it you're going to have to talk to whoever's managing your insurance for you to really come to understand it. Find out what your cash surrender value is.
The Shedmeister.
This is the deep dive into. This is the very back of the shed. You're clearing off cobwebs probably. You want to make sure that cash surrender value is matching what your projections were, right? I very often find people that have a 10-year-old policy, especially if they have something was called a universal life policy, that was essentially that bucket was invested in mutual funds. We haven't seen fantastic growth within those. We have policies that were whole life policies, which were invested by the insurance company essentially, have done a little better on average, but that's been, as we've seen, interest rates and things decline fairly fast. We want to make sure that those projections are in track with the original illustrations. And that's something that also, at that point, to my mind, it makes sense to run past your accountant and say, okay, this is the money I've put in. This is the money that I have yet to put in. This is what the CSV is, the cash surrender value. And the other side is you want to find out what your ACB is, your cumulative cost base. Because we have the value of the insurance. The next slide I have will explain it a little bit better. But essentially, we're always taking a look at this saying, well, do we keep this as a corporate asset? Do we borrow against it personally? Or if the returns haven't been great, or if your cash flow has been different, or your goals and your plans have changed, if it doesn't make sense to have it anymore, what are the tax implications of surrendering this policy? Like any investment, it's the amount of money that you made on top of it that's taxable. The thing with this is not just the pure dollars you put in, because you also got the benefit of the insurance. So over time, that accumulated cost base, that ACB, actually goes down to zero. And the other big part is where I've had people who would not naturally be people who would stay permanently incorporated. They're going to run out of corporate assets by the time let's say they retire at 55, by the time they're 65 or 70, they're not going to be incorporated anymore. And we're planning for a minimum timeline to 90. My plans normally go to age 100, but we sort of say, okay, well, by 90, that's kind of that's on the farther end. So if we're planning to get some money from this, but it's not a significant enough policy that it's going to make a really big difference, and it requires you to be permanently incorporated, for the rest of your life. If that's 20 more years of incorporation, that is a real cost, right? Annual filing, tax returns, all that stuff. So it's one of those things you want to think about in relation to the value of it. Is it sufficient enough that it justifies the need for ongoing incorporation?
Right.
So this is a standard an illustration. This was a sample illustration I did for somebody. Typical sort of situation where you pay $50,000 a year for 10 years, put it into a permanent life. This was a Canada Life policy, and it just illustrates this one part that I wanted to take a look at. So here, after 10 years, you've put in $500,000. At the current dividend rates, it would be worth about $82,000 on top of what you put into it. Pardon me. This part here, this ACB, that tells us that's what the value is of the money you put in minus the benefit that you got, essentially, right? So at that point, we would say, okay, well, if you turn this in, you would have a taxable gain on full surrender of the policy of $94,000. If we're 10 years into a policy or 7 years into a policy, basically where we've gotten over the break even and you're not really sure about it, especially where it's a smaller policy. I know $500,000 is a serious amount of money, but in the area of permanent insurance, where we're borrowing against it in retirement, this would be on the smaller end of that. And especially if somebody put it in maybe a little bit later, the value you're borrowing against, we really have to assess whether or not it's worth it, and you have the tax liability to justify it. But at that point, you're taking a $94,000 taxable gain. Now, 2020 might be the year to take a taxable gain when everything else has been really challenging. A little bit like some of the other decisions that we'd make around, taking the gains in investments and things like that, saying, well, we're not going to make a lot of money in our conventional business, so maybe we want to take the gain here and then say, we made some money on this and we replenished cash flow. So it's one of these asset classes you can generally put it on pause at this point and let it sit and borrow against itself. You can borrow against it explicitly if you need money, but you want to use that as an asset class to continue your regular operations, because you can borrow from your corporation to keep your regular operations going. Or you also should be assessing the value of surrendering the policy or partial surrendering the policy, depending on what your situation is. Just remember that this is an asset class that has some tax implications, but there is some real value there. So it's a good time to take a dive into that. This invariably involves talking to a person who is, that is managing the policy, but also then talking to your accountant and saying, let's make sure we have this asset class. We know what we could do with it.
All right. So moving forward, what's next on the agenda?
I just put this slide here. If you are not sure if you have one of these policies, this is usually the kind of slide that usually the kind of thing you'll see in an illustration to say, oh, this is the structure of how this works, line of credit and all this stuff. So last thing I wanted to touch on, critical illness insurance. This is something that's used very regularly within the professional markets in Canada to have to provide protection, but also to create a tax benefit. And it's a bit of an either or, but it's something that's been used very consistently. And the basic idea of critical illness insurance, unlike disability insurance, which tops up a portion of your income if you're unable to work, critical illness insurance is much more of a blunt instrument. It pays out a lump sum based on you being diagnosed with a medical condition and not surviving some period of time. Used to traditionally be 30 days. That's become shorter now. But in general, it was a lump sum of money that paid out if you were diagnosed with a covered condition. The idea was it was money that would allow you to get better, or if you were permanently impacted, it would be money that would be in your corporation that would let you fund a pension plan or fund your ongoing operations. So it's a sort of a separate type of insurance. The big thing is So on a cost reduction side, there are different options offered by the different insurers. We have as short as a 3-month deferral. We have a contractual right for some of the permanent policies to, if you've had it for more than 5 years, to defer for a full year. One thing I've mentioned for a lot of people, and a lot of people when they've worked with somebody who may be from the insurance world who isn't as comfortable with the corporate side, they've bought this type of policy personally, and very often it's, these can be quite big policies. It can be $500,000 or $750,000 or $1 million, where somebody has a large mortgage and they say, yeah, I really want to make sure that if I get sick, that the mortgage is paid off. One of the things at this point would make a lot of sense to consider is, if that's the case, if you own this personally, to consider moving this to your corporation. It is not like life insurance where it pays out tax-free, so it's not as simple as an answer as that. But it does, if you pay for it with an 89-cent dollar, you've reduced your net cost of that insurance quite significantly. And it makes sense to either say, well, I have to take that money out of my corporation, but if I'm really, really impacted by a medical issue, this could flow into a pension plan, and that tax cost could be mitigated over a longer time period. And if we're looking at a situation where after-tax dollars are going to get even more expensive, it makes sense to consider that. It pays tax-free to your corporation, but it just saves you those 11 cents, right? And then you could dividend it out, or you can flow it in you can keep it as retained earnings. It's something that when we do the math and we say after-tax dollars within the market that we service, it usually makes sense to make that change. Where it's being used as a tax strategy, this is a strategy that we employ regularly. The basic idea is that the corporation pays for the insurance, and the person personally pays for what's called a return of premium. So that basically says that after 15 years, minimum 15 years, if you haven't had a claim, they will refund all the money that you've put into it. The reason that people split the benefit is that the return of premium of the policy you could pay for with after-tax personal dollars, with the plan being that the money will pay out to you personally as after-tax dollars, because there wasn't any net value for the corporation. You've decided that you no longer need the insurance in the corporate side. You never had a claim, so now you're going to be paid out personally. And because you paid for that, the right to have those dollars back personally, they get paid out without any tax liability to the person. Very often is used for paying off personal loans or paying off mortgages or things like that.
How safe is this going to be from future legislation?
It's a question. It's one of these things where basically your maximum risk is the taxation you paid on the personal dollars. If they come down with a hammer, the return of premium is structured. It's guaranteed.
No, I know that, but if you paid your premiums with after-tax dollars and insurance is very strong in Canada, and I'm sure it is in other countries, and the governments are loath to jump on insurance. But you're saying that you return a premium because you've paid, let's say, half of your premiums with after-tax personal dollars. Your return premium, you can collect that, but the government might change their minds on that.
It is,
or could they not touch that with a barge pole? Is the insurance watertight?
And that's.
I'm asking for your crystal ball here.
It's like anything. I mean, it's the same as saying, well, capital gains inclusion rate's 50% today. Could that be different in the future? Well,
that is not as watertight as many of the other things are insurance.
Nothing is watertight when it comes to taxation.
Yeah.
So we had exactly that same concern. We only started employing this when it was really justified.
Mm-hmm.
The maximum risk basically is to say, well, they've disallowed this. You've paid some extra personal taxes on these dollars, and it's going to flow back to your corporation. So we had some tax hit. On the other side, we actually didn't employ the strategy. We were exactly like you. We were worried about this. we never employed the strategy until we started to see these policies, the first ones put in place, until we saw those actually being paid out successfully without challenges, and that's been a few years now that that's been happening. We didn't actually start using the strategy until we saw it being successfully paid out as intended. Now, again, like anything, the taxes could be changed in the future. We have had some people that have said, look, you know, I don't really, I don't want to be involved in the tax strategy side, and I'll just do a conventional return of premium. I can defer corporate dollars into this policy. If I never need it, then I get the dollars back at the corporate level. I'm fine with that. On our side, it makes it easier, to be honest. And so we basically place it to say, well, we can do it this way with these risks and with this cost. On this side, we are without those risks, but we also don't have the benefit that would be associated to it, assuming that it pays out successfully. So far, these policies have paid out successfully, so we've been comfortable either way on it. But we've had a number of people where, let's say they are funding permanent insurance policies, and we say, okay, we're planning on a 20-year funding of that. The last 5 years are actually covered by the return of premium, and we have a set cost going forward. It's, you know, there are many paths, right? So the reason that I mention this is we tend to be on the front end of these policies. They require very specific things to be what we consider compliant. The early policies that were put in place tended to be very heavily leveraged to mostly insurance cost, very little personal cost. The policies in general that we see now, they're about 30% for the return of premium and about 70%, depending on age, paid for by the corporation, right? So the net value of it is quite good if you look at that 70% corporate dollars, 11-cent taxed versus personal dollars at 50-ish%. So that's where the benefit comes in. On our side, the thing that we see missing with these policies, we have a number of these, but they're certainly not something that it's, you know, anybody and everybody. These have been sold pretty aggressively into the dental community in particular. The thing that we see missing is that it requires things like a corporate needs analysis, a legal written ownership agreement. So saying, this is who owns the different parts of this, and this is a legal agreement with your own corporation. And we need to make sure that it's explicitly shown that you are claiming the personal component on your personal taxes. That can be a taxable benefit from, you know, that's written as a taxable benefit, or you can write a check to your corporation for that amount, for example, and then the benefit is paid. Or in some cases, some insurers will actually let you submit that check directly for the insurance policy. My reason for saying this at this point is, in almost every situation, these things have not been in place when I've reviewed this, where people have this, where dentists already have this in place. If the policy is going to, if the structure is going to work, if it's ever claimed, if it's ever investigated in the future, these are the specific things they're going to be looking for. So best practices, you'll want to take these steps.
Okay. So I think we covered critical insurance quite well there. It's a big insurance in Canada. I know that they were rolling it out in the US a little bit, 2005, 2006, and I think it's a little more common now in the US. I'm not sure if it's in other jurisdictions. It certainly doesn't have the market impact in the US, I think, yet, as it does in Canada. I'm not sure about other places, but I know when I was down in the States, the insurance guys were chatting to me about critical insurance, because like, it's really big in Canada and we're going to try it down here. And I'm not sure it got legs.
It's we're unique. We're actually the only jurisdiction where we actually have guaranteed premiums for it. Your disability premiums are subject to change over time. They can change you as an insurance class. For critical illness insurance, I believe we're the only jurisdiction where it's actually where we actually have a guaranteed rate for the term of the policy, like with your life insurance, right? Yeah, critical illness insurance it's an interesting product. It was actually developed by a doctor in South Africa who first came up to. He was actually the person who worked with the person who did the first heart transplant. His name was Dr. Marius Barnard, and started seeing people coming to him with, you know, massive impacts of he did things to save their life, but their life was so difficult because they didn't have life insurance didn't pay out because they normally would have passed away, and this allowed them to sort of bridge that gap to say it's a lump sum of, you know, life-changing medical issues. So it's where it originally came from.
Yeah, actually, I the BBC did an interesting story about that transplant operation in South Africa, because racial politics came into it, and they actually had a debate about it. They're like, well, if we have a good candidate for the surgery, if it's a black person, perhaps we shouldn't do it because it'll look like white physicians experimenting on a black person as a guinea pig. And if it goes wrong, that life was throwawayable and that life was negligible. If we do it on a white person, it seems white privilege. But and it's in the grand, they actually had a big debate about this. The physicians like, how is this going to play out? And so it turned out that, okay, well, we prefer rather to do it on a white person because it doesn't look like we're experimenting on someone and the person's choice and this and the other. But anyway, it's really interesting because the BBC does a much better job of describing it than me. But that was actually something that came up because at that time it was apartheid in South Africa. And that was, there was good people in an upside down backward system, but they were good people, and you could see that something like that impacted something so altruistic as that. We're doing transplants, and maybe it just won't be good if we do that, and it didn't work. Anyways, it's quite an interesting documentary if you dig it up. I listen to the BBC when I work, and every now and then they'll do a documentary, and I remember it was like I listened to it between patients, and I was just like, I want to go back to the next patient. This is so interesting. Which now you can't do because we're dressed up like Smurfs now with all our, if we can't hear anything, can't go in the operatory or can't go anywhere. We have to work on the patient. So dentistry's changed. I might have to go cordless little headphone there. But.
Well, if you get to the stage where you need hearing aids, my mom has them, and her phone just goes directly to her hearing aids now.
Wow.
It's pretty convenient.
Yeah. So have we covered everything in insurance there?
Yeah, I think that's a good run through. I mean, it applies to any of your insurances. I mean, honestly, it's probably a good time to go and beat up anybody, whether it's property insurance or your personal insurance.
Check the office overhead. Yeah. Just to give people a different perspective, they had this office overhead insurance in Canada, and there's a pandemic thing you could add, and they called it pandemic. And the whole big kerfuffle here is the college here in BC, March 16th, said you have to just do emergency dental care only, nothing elective. Well, that's great. In some regards, very clear. And then March 29th, I believe they said, well, minimize your elective. Now, the insurance company is saying, well, that means you can still work. And the thing is if we stand back and look at things now, I would be loath to buy pandemic insurance because the one, now that we've in the middle of it, is when would a government ever say a dentist cannot see a patient come hell or high water? Because the dentist doing emergency care only is helping to keep patients out of the hospitals. And if we're in a pandemic, the hospitals are going to be beating people back with a stick, right? And so in some regards, you'd have to have very clear definitions of what constitutes a pandemic, because dentists in Canada are looking at 99% of our billings we can't do by government mandate, but it still doesn't qualify as pandemic because that 1% we can do, and you're like, oh my goodness, the fine print of this insurance and all these people have been paying it, and they're up in arms and they're upset. And yes, things will play out and people are looking at it, but anyway, that's kind of what's in the air at the moment.
Yeah,
and it's rather interesting.
It's something that I hear regularly about.
Yes,
and it's interesting. We get, we tend to get statistics on our side. Obviously, we tend to be people who like statistics. but we very often have statistics saying like, what is the, what are the claims versus payouts of a particular type of policy? I can tell you a critical illness insurance policy where it's like, well, it's do you meet the criteria of this type of cancer? Or is it life-threatening? Is it not life-threatening? Of course, that has a much lower, that'll have a lower payout ratio than life insurance, for example. Life insurance is like 99.95%, let's say, something like very, very close to 100%. Claims versus, and then when the claims don't pay out,
unless you're
99%
murdered,
of those,
it's going to pay out. Or you commit suicide. Murdered by your spouse, it ain't paying out.
Well, it's a suicide within 2 years, right?
Right.
So it's suicide within 2 years. After that, it's fine. And that has come up before. They actually have had people that did the math wrong and ended up not getting paid out, unbelievably. But on life insurance, when it doesn't pay out, it's because they found out the person was still alive, right? Travel insurance has a much higher rate, right?
Yes.
So somebody fell off a motorcycle when they were drunk and they don't have a motorcycle license and they weren't wearing a helmet. It's not going to pay out in that situation. If we looked at those statistics for the pandemic coverage of the insurer that you're referring to, is it 99% declines? Like, it would look like an insane number.
Yeah.
And it's definitely going to cloud that side of the industry for a while. And people are going to lack trust in it.
Yeah.
Hopefully it doesn't come through to, the other sides of the industry. We always see some blowback. But we try to sort of put it into context, and certainly where we're talking about life insurance, it's more straightforward. But in general, I find that, it feels unfair because you say, well, we have a pandemic.
And it's called pandemic, and we're in a pandemic.
Yeah.
And you're saying no coverage. Yeah, it's just.
It really does. It not only feels wrong when you look at the situation in any objective eye, you say, this is what you're supposed to be indemnifying against, right? Small cost against a significant risk. If you mispriced it, that's not really shouldn't be the fault of the insured person.
Yeah, no, absolutely.
No,
really interesting. So in a couple sentences, I want you to boil it down to Mark's 5 top tips. 1, 2, 3, 4, 5. Okay. Insurance.
Yeah. So
couple sentences. Boom, boom, boom.
Review your beneficiaries.
Yeah. The shed check.
Make sure that you know what you have and you know why you have it.
Get old girlfriends and boyfriends off and the new ones on.
It's ideally, yes. Or just make your parents the beneficiary or something simple, or your kids.
Yeah.
The other big thing is, and this, it's analogous, is also do your, if you haven't done your will or you haven't updated your will, please take a look at that. Living will, and your, and any of those documents that make such a difference. In times
okay.
when things
So
go
update
wrong.
will. Yep.
Update will. And if you have investments or tax strategies using insurance, that can be critical illness or that can be life insurance. You need to get an assessment of it. And you also should be, before you ever do any of it, you should always talk to your accountant. But at this point, you definitely want to be in touch with your accountant and say, you have more time on personal returns. Let's take a quick look at this. I just want to make sure this all makes sense and that we're not missing an opportunity, or that I'm not putting money into something that's not benefiting me.
Okay. Last question.
Yeah.
What's that painting behind your head there?
Oh, that is Erasmus. So it's a Hans Holbein print. I did my last semester of university at the Erasmus University in Rotterdam. This was in my German grandmother's living room in Berlin. And when I graduated from university, she gave me that as a graduation present. So she got it from, I believe, an aunt or a great aunt or something. So it's a possibly old print of Erasmus.
There we go.
Yeah.
So that's a little family heirloom.
Yeah, it's a nice memory. She was an amazing person.
Hmm.
You know, I think anybody who lived through the wars, there's a lot to be learned from those people. So yeah, it's a nice memory, and it brings me back to her apartment.
Yes. No, that's fantastic. Well, thank you, Mark. It was wonderful. You breathed some life into a critically dull subject of insurance. I didn't get ill.
I know it's a tough one.
Yeah, yeah. No, you did well. Thank you so much.
Right.
And
Okay.
next will be the government tomorrow, and we're bringing in
Yeah.
Albertan because we know how much they love governments.
Well, we're actually going to bring a fellow Cloverdalian.
Oh, I keep thinking he's from Calgary. That's the
He
other brother,
is the other brother. That's the other twin.
Chris and George,
Um,
right?
yeah, Chris and Adrian. So
Adrian.
Chris
Adrian.
is my partner in Broadreach here, and Adrian's he's the owner of Playjex,
Okay.
where we originally started from.
In Alberta,
Um,
Playtex, Alberta, and Broadreach in BC.
Broadreach, BC,
All
which is why
right.
we get to have all the sailing references and all the I get to and then Broadreach is a sailing reference as well. So it's it's more things close to my heart.
There we go. There is a yacht club in Calgary, if you can believe it, and it's not a remote control yacht club, but they do have one. Amazingly, but never mind.
When I moved to Canada, I moved to Calgary.
Yeah.
Yeah, that's I had no idea a place could be that cold and have human beings in it.
Yes.
That
Yes.
was an eye
Yeah.
opener.
Yeah. Yeah. I know it can be very bad in the Saddle Dome when they lose.
Yeah, oh, yeah, I'm sure.
All right.
Yeah.
Thank you so
Good
much. Let's
stuff.
wrap it up. That was
Great,
awesome.
thank you.
People will post questions and then we'll contact you about the answers. We'll have a lot of extra information posted beside your interview on the Pure Effect site. But this has been Pulp Nonfiction, the insurance edition. Ta-da.
Wonderful.
Thanks, Mark.
Great. Thanks so much. Take care, everybody.